Hello everyone and welcome back. The year 2026 is off to a powerful start for global financial markets. In just the first week of January, we are seeing major developments across technology, stocks, monetary policy, and geopolitics. CES 2026 is officially underway, setting the tone for the future of artificial intelligence, robotics, and automation. Wall Street is projecting the S&P 500 to reach new all-time highs this year. At the same time, the Federal Reserve is heading into a leadership transition, with growing expectations around interest rate cuts. On the geopolitical front, the Venezuela crisis is sending shockwaves through oil, gold and energy markets. In today's video, we'll break down how all of these events connect and what they could mean for US markets, global investors, and your portfolio in 2026. If you follow financial news seriously, make sure to watch till the end. Let's start with CES 2026. CES is not just a technology expo, it's where industries reveal what the next decade will look like. This year, the dominant theme is clear. Artificial intelligence is moving beyond software and into the physical world. NVIDIA's CEO, Jensen Huang, has placed a major spotlight on AI data centers, next-generation GPUs, robotics, and autonomous systems. NVIDIA's market value is approaching $5 trillion, and investors are watching closely for signals about future growth. One of the biggest shifts we're seeing is the rise of physical AI. These are intelligent machines and robots designed to operate in real-world environments, not just simulations. Platforms like NVIDIA, Omniverse and Cosmos are designed to train robots faster and more efficiently, allowing companies to deploy automation at scale. AMD and Intel are also pushing aggressively into AI, acceleration and enterprise solutions, which means competition is increasing, but so is innovation. For the stock market, this matters a lot. Strong announcements from CES could fuel further rallies in AI and semiconductor stocks. Technology could once again lead the S&P 500 higher in 2026. However, there is also a risk factor. If investors begin to fear that AI valuations are running ahead of fundamentals, we could see increased volatility in tech stocks. Now let's talk about the broader market. Wall Street forecasts for the S&P 500 in 2026 range from around 7,200 on the conservative side to as high as 8,200 in more bullish scenarios. The average target sits near 7,500. Earnings growth is expected to be around 14 to 15%. While the so-called Magnificent Seven tech companies remain important, analysts are increasingly optimistic that earnings growth will broaden across sectors. January is a critical month for markets. It often sets the tone for the entire year. Key economic data releases, including labor market numbers, inflation readings, and trade data, will shape expectations around Federal Reserve policy. If job growth shows signs of cooling, markets may price in more rate cuts, which would be supportive for equities. On the other hand, if the economy appears too strong, inflation fears could trigger short-term corrections. The big question for 2026 is whether this is still an AI-driven rally or the start of a broader market expansion. Most analysts remain cautiously bullish, but they are closely watching tariffs, global trade tensions, and geopolitical risks. Turning to the Federal Reserve, Jerome Powell's term is set to end later this year, and markets are already speculating about the next phase of US monetary policy. Interest rates currently sit in the mid-3% range after multiple cuts in 2025. Inflation has cooled significantly and is hovering near the Federal Reserve's long-term target. Markets are pricing in 1 to 2 rate cuts in 2026. However, if the labor market weakens faster than expected, that number could rise to 2 or 3 cuts. A new Fed chair could also influence policy direction. If the next leadership leans more toward growth support, stocks and bonds could benefit from a more accommodative stance. Lower interest rates generally support equities, housing, and long-duration assets. But if inflation reaccelerates, the Fed may be forced to pause or reverse course. This balance between growth and inflation will be one of the defining themes of 2026. The situation in Venezuela has escalated significantly, with major implications for oil supply, energy stocks, and safe haven assets. Venezuela holds some of the world's largest proven oil reserves. In theory, increased production could help stabilize global oil prices. However, infrastructure challenges, political instability, and sanctions mean that short-term supply risks remain high. As a result, oil prices have become more volatile, and energy stocks like major U.S. producers are seeing renewed interest. At the same time, geopolitical uncertainty is pushing investors toward gold and silver. These assets tend to perform well when risk perception increases. For global markets, this crisis highlights how quickly political events can reshape supply chains and commodity pricing. Looking at the global economy, U.S. economic growth is expected to remain around 2%, supported by AI investment, productivity gains, and moderate fiscal support. Global GDP growth is projected near 3%. While trade tensions and tariffs may slow some regions, AI-driven efficiency gains could provide a powerful tailwind. Inflation is expected to continue easing, allowing central banks more flexibility to support growth. However, risks remain. Geopolitical conflicts, labor market shifts, and policy uncertainty could introduce sudden market shocks. From an investment perspective, technology and AI remain key long-term themes, but diversification is more important than ever. Many investors are also viewing gold as a hedge against uncertainty. To sum it all up, 2026 is shaping up to be a year full of opportunity, but also heightened complexity. AI innovation, Federal Reserve policy, geopolitical risks, and earnings growth will all play major roles in determining market direction. Do you think the bull market will continue, or are we heading toward a correction? Let me know your thoughts in the comments. If you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and share it with others who follow the markets. Thanks for watching, and I'll see you in the next video.